Let's talk some of the macro and some of the flows. Firstly, with Kevin Green, our senior markets correspondent, back with us for a look here. Firstly, at the S&P open interest and options. What are we seeing, Kevin?
You know, Oliver, for the last couple of trading sessions, we've been just pretty much gyrating around this 5850 level for the S&P 500, which I think is actually a pretty decent sign here, as liquidity has actually kind of gone to the downside if you're looking at the E-mini S&P futures. But if we're actually looking at it more of a, the 10-day time frame here, I would say 5850 is going to be your point of control to really kind of focus on over the next couple of trading sessions here. And on the longer term time frame, which is the open interest chart that we have right now, we're still kind of back in that megaphone pattern, or that wedge pattern that we have here, taking place. So you want to see some buyers actually trying to step in at around the 5,800 level. If you're looking at more of an intraday basis, you want to see buyers actually stepping in around right now. 5,830 is your first initial area of support here. And if we kind of do break down, holding that 5,745 is going to be key before we actually do kind of create a little bit more of a triggered sell-off here. I am not liking the fact that the advanced decline line is starting to inch to the downside. And then also when you're looking at the RSI starting to kind of lose, or a little bit of steam here, just showing that price momentum has stalled out. More of a consolidation, but if you have that consolidation also mapping with low liquidity in the market, that's where you kind of get these pullbacks occurring here. But for now, I still think that we're in that bullish trend. I'm not too concerned with this pullback for the time being. But if we have some bad economic data, or we do see maybe some election fears coming into the picture here over the next couple of trading sessions, I would get a little bit more concerned.
Okay, we've got the advanced decline taking a tick down, but it seems like the theme that we were talking about generally over the last month still kind of holding in. I guess if this makes lower lows, the advanced decline line on the chart, then we start to worry about a breakdown. Do you use the advanced decline line with that kind of like technical perspective?
I do, but I also map that out with the RSI, or even looking at a MACD. So if a MACD was crossing and you saw that advanced decline line move to the downside, that's where I would get a little bit more concerned. Right now, you could have the majority of the stocks kind of, maybe losing some steam, staying flat, or even having some losses. But this could be the time where mega cap tech kind of comes back in and starts to take a little bit more command. So that advanced decline line is not the ultimate gauge there. It's really a breadth indicator rather than where the market's going to actually go moving forward. So understanding those dynamics, I think, are going to be key. We have that volume chart up here. So for the intraday levels that I'm looking at, 5875 is going to be the key area of resistance if we are going to be able to get some buyers to step in. We have that point of control sitting at 5850. 5830, once again, is that immediate area of support. We could actually see that pretty much since last week. And then kind of going back, if we go below 5800, that's where we kind of erase those gains and it gets a little bit bearish here. I also have the RSI. Now, let's just be mindful of this. RSI, since Monday of last week, actually continues to make lower highs, right? And so that's kind of your bearish indicator. And actually today, just because of this morning's price action, it really kind of fell off a cliff. So you want to actually see that maybe go to that oversold level, or oversold levels hitting that 30, and then some buyers kind of stepping in here. But once again, those are going to be the key areas for us to be able to hold as far as support. Even if we are able to maintain here, maybe we have some good numbers coming out of Tesla. Some of the other mega cap names are going to be reporting next week. That could still lead us to the broader uptrend that we've been so accustomed to over the last 2 months, 3 months.
Okay, so yeah, the RSI seems like a little bit of an issue, and maybe not showing up in price just yet. But I feel like we should be, I guess to your point, kind of on our toes a little bit more than we were the last couple of weeks when it was. We kind of transitioned. It was like kind of a faster paced rally, and then last week was kind of a slog rally, and now this is kind of a treading water at this point, but no major breakdown just yet, right?
Yeah, no major breakdowns just yet. The last thing I do want to kind of highlight here, Oliver, everybody's kind of, concerned about what the 10-year is doing, and rightfully so.
Yeah, you got a yield spread for us. Sure, hit me.
Yeah, but what I would say is that I believe that's still a little bit of the unwind for the FOMC meeting, and then also kind of looking at this, 2-year, 10-year spread. So this chart and that white line is the S&P 500, and then that blue line is going to be that 10-year, 2-year spread differential, if you will. If we kind of go back in time, we're still at very historically low levels. So you want to see that spread kind of widening out here. And if that's going to be the case, I think it's going to be on the longer end of the curve, the 10-year, 20, and 30. already being sold off. And that, I believe that we're going to see more of a normalization. I also have basically a regression line there. And you usually see on average for this chart, you usually see a little bit more of a spread of around 1.1 to 1.3% between the 2-year and the 10-year. So I wouldn't be too concerned about that yield move right now. If it was complemented with a weaker dollar, I think that would be a little bit more a concern for growth, but that's just not the case. So I think we continue to hold serve, and we're still in a market where it's yields up, equities up, yields down, equities down. I think that's going to be the case for us over the longer term.
All right, especially when it comes to the broad market. Russell, maybe a little bit different so far last couple of days, but it doesn't have to be that way. Certainly doesn't. To your point, bear steepening should be more of a positive economic indication. Thanks, KG. Appreciate that. Good context and long-term connection there.